Good morning, everybody. Welcome to our next webinar in the series, Make Your Money Move, a guide to sustainable investing. Today, we will lay the foundation of impact investing for you and share what sets it apart from other types of investing. First, some housekeeping. Everyone is muted, as we are all used to at this point. So if you have a question, just type it into the chat function on the side of your screen, and I will either ask Samuel for you right away, or I'll save it for the Q&A at the end. Now, a quick word about who we are at Responsibility. I think of us as pioneers of impact investing. We've empowered millions of people in emerging markets since 2003 with access to finance. And we also invest in sustainable food and agriculture, and our initiatives to fight climate change through finance have reached nearly $1 billion US. All right, I'll hand over now to Samuel, who works in business development at Responsibility and is your impact investing guru for today. Over to you, Samuel.
Thank you very much, Stacy. Well, also a big welcome from my side. It's great to see everybody here. I heard we had quite a nice turnout from also across different parts of the world. So I think it's not only good morning, but also good afternoon to some of you guys. We still have a few people coming in, what I'm seeing, but I would like to start off this webinar with a quick wrap up of the first part that we had last week. Where we took a quick look into the history of investing. So we went across time, starting in 1700 BC, seeing a bit what's been done through the time on the investment universe, how we have been interacting with this. We've also learned that even before the 2008 financial crisis, we haven't really made a whole lot of money from our saving accounts. And that towards the end, we took a quick look into the UN Millennial Goals and the United Nations Sustainable Development Goals. So I would like to transition to the Sustainable Development Goals. And for that, we have a slide. So Stacey, if you could give me the access, I can share my screen.
You should have it now, Samuel.
Very good, thank you. So if you just bear with me 1 second, I will show this. Very good.
Perfect, we see it.
Very good. So what you see in front of yourself is the 17 Sustainable Development Goals that have been defined by the United Nations in 2015. These goals are a succession of the Millennial Development Goals that were established in 2005. And as you can probably see, there are a series of targets that we're trying to achieve. So we address topics like no poverty, zero hunger, but we also go into topics such as responsible consumption, life below water, life on land. So we're addressing a whole range of issues that the goal to achieve those is to create a more sustainable and better world for all of us. Now, one of the core components of the United Nations Sustainable Development Goals is this is not only a developing country issue. This is also things that we are seeing that we need to address here in the developed world, in Switzerland, in Europe, and the United States, especially when looking at topics, for example, like good health and well-being. We know very well that this is not only something that needs to be addressed in the developing world. So the other unique thing about the Sustainable Development Goals is also the fact that it has been put with a number. So to achieve these goals by 2030, we need to invest approximately $2.5 trillion every year. So this is not only a huge amount of money that needs to be invested, but it also poses a very interesting investment opportunity for people who have the goal to address these issues while also making financial returns. To briefly wrap up this summary of the United Nations Development Goals, I would like to share with you my personal favorite of the goals, which is goal number 17. Goal number 17 is the partnership for the goals, and basically summarizes the fact that we need to do this together. So this is not something that an individual country or an individual organization needs to address to achieve, but this is something that we need to do all together in order to safeguard to guarantee the achievement of a better world by 2030. So before we go and look into why these United Nations Sustainable Development Goals are crucial for sustainable investing, I would like to share with you, or like to ask you a short question with our poll. So Stacey, if you could launch the poll question, please.
All right, it's launched. People are voting.
Very good. The question of the poll is, do sustainable investments versus conventional investments bring either a equal or higher return or a lower return? So let's see what you guys think about this topic.
Let's wait a little bit longer. We've only got about 60% of the people voting so far. A few more seconds.
Very good. We're looking forward to see your point of view on this.
All right, people are still participating.
Not really a trick question, so.
All right, 10 more seconds and then we'll let it go.
Very good.
And here are the results.
Perfect. So I don't see the results, Stacey, so maybe you can help me out for a moment on that.
Sorry, it says, I was muted. It says 74% have equal or higher return and 26% think that it has a lower return, that sustainable investments have a lower return. What do you have to say about that, Samuel?
Great. Well, I think most of you guys are on the right track. Sustainable investments do indeed have been proven to have a equal or better return, especially when considering longer time frames of the investment period. The main reason for that is also because in sustainable investing we include certain risk factors that other conventional investments that do not really consider. So the chance of something going wrong over a longer period of time in a conventional investment is higher, hence having a more negative effect on the investment opportunity. So looking at this, I would like to take a look at the investing landscape with you guys, and basically starting on the left side, we see the sort of traditional investment practices. As you can see, the main target or the sole target of the traditional investments, and these are the investments that we've been pursuing for sort of the last couple of decades, are competitive financial returns. So we do not apply any filters other than financial components, and we seek to maximize our profit, cost what it will. You have some big players in there, like the big asset managers, such as BlackRock, but also the big banks that are mainly acting in the traditional sector. And this is also, if you do not take any decisions on your own on your investment strategy, is basically where your money is being invested and where it's being played at. So this is also the status quo, because unfortunately for the time being, there's no opting out of traditional investment. You have to opt into sustainable investing, and that's when it comes up to you to take a much more active role on setting up your investment strategy. When we move a bit to the center towards sustainable investing, I often get asked the question: so what is actually the difference between sustainable and an impact investing? When you look at the offerings. So first of all, differentiating sustainable investment from traditional investment. In sustainable investment, we start working with filters. So we have the ESG risk management. So ESG stands for environmental, social, and governance practices or policies. To give you an example, environmental practices or policies look at how the company's operations function with the environment surrounding. So if you have a farming company, how do they treat the land that they're working on? Are they using poisonous pesticides? Are they polluting water? Is a production company emitting large amounts of CO2 emissions, etc.? So these are a filter that you would look at these components. The social component looks at how the company works with its employees and its communities that are surrounding the production company or the organization. So do they pay these people fair salaries? Do they give them access to health, give them access to additional education, etc.? And also how the community around it is affected. Do they take away land from them, or do they impact them in some negative or positive way? The third factor that we're looking at is the governance factor. And this is mainly how the company is operated. Do the company stick to good practices? Are they involved in corruption? Are they involved in other forms of breaking rules or contributing to achieving these rules? So with sustainable investing, we apply these filters, and on top of the financial components that we look at when selecting a company, we also apply different levels of ESG filters to select the company. To give you an idea of what that means, there is different levels on how you can apply these filters. One way is to do a negative screening. So you want to avoid the company that you select to do any harm in the sectors or in the practices that they're active in. So for example, one of the common factors that we see is sort of the negative screening on companies that are involved in tobacco, in oil, in pornography, or in alcohol. So you have a very basic screening saying, okay, we simply do not do any business with those, so you also don't invest in these companies. Now, when moving over to the more impact investing sector, the one big difference on impact investing versus sustainable investing is that usually sustainable investment solutions mainly focus on the negative screening component. In addition, the Global Impact Investing Network defines impact investing as investing in investing while seeking a developmental impact on a social and on an environmental perspective, and also be able to do that on a measurable way. So you're not only looking to make a financial return, but you're also looking to how you can contribute to the developmental component, and you want to be able to measure that. So as you can see on the third line, the impact investing also includes high impact solutions that you target with the investments. And basically, the impact investing is the one investment activity where you're able to compete, bring competitive financial returns. You're applying ESG metrics when selecting the companies. You're bringing in high impact solution, and you're also bringing in a way to measure the impact that you're generating. So bringing that in a bit of a methodological framework, this means that you have to have an intentionality, and your intentionality has to be that with the impact and with the return-seeking activities that you're practicing, you also want to contribute to the developmental component. On top of that, also impact investing brings in an additionality. Now, additionality means that the companies that you work with have an additional added value when working with you as an investor. I would like to bring in responsibility, the company that I'm working for, as an example. We have a technical assistance team that companies have access to that help the portfolio companies develop certain solutions to problems that they face on an operating land scale. To make that more tangible, I would like to give a case study that we had in Bolivia with a quinoa production company. They were facing the issue that I had relatively high land erosion that were generated from wind. They approached our technical assistance team and they developed a relatively simple concept of fencing the fields with a shrubbery with sort of bushlets to break the wind. With that, they were able to stop the top level erosion of land and increase their production yield by about 30%. So as you can see, the fact that we were working with this company on an investment level, so we were providing financing for this company, they also gained access to certain technical support that was then able to solve a problem on an operational level and improve their company's proceedings and also their revenue, which makes it a more attractive investment for us as well. Now, we initially touched upon the fact of the negative ESG screening. In impact investing, we also apply a positive ESG, environmental, social, and governance screening. So this means we don't only want to work with companies that do no harm, but we also want to work with companies that are best of class in their sector and that also contribute positively to the developmental components in the sectors that we're working in. Responsibility has three core focus topics that we're working in, being one, financial inclusion, sustainable agriculture, and energy finance. And the ESG filters are applied differently depending on the themes that we're investing in, because you do not always cover all the components of the ESG metrics in all the themes. To give you an example, if you look at the microfinance institution, you're most likely looking mainly at the governance practices, because you do not want to work with companies that are working in bribery, that are working in abusing their clients from a target perspective, from a loan perspective, etc. But you will not find very many environmental components unless you're working in the green financing sector. If you're working with an agricultural company, the environmental component of the ESG screening obviously is much higher, because their impact on the environment from a biological or from an organic perspective is much higher. So it's important to filter out companies that, as I mentioned earlier, work with, for example, poisonous pesticides, and promote to work with companies who are pursuing organic farming activities. So now we've looked at briefly how we go about to select these companies. And as we've seen in the definition from the Global Impact Investing Network, the selection process is one part of the impact investing. However, people that invest with us also want to know, what is my money actually doing? So there we go about, and we ask the companies to collect information on us on the impact that we're generating. So to give you an example, on the energy sector, our financing is linked to requirements to reduce about at least 20% of CO2 emissions when we finance the company. So the company then needs to go about and report their activity, for example, if they give out loans or if they install new solar panels, into a tool that we've developed, where we then collect the data and we're able to report on exactly how many tons of CO2 have been reduced through the investment. We've been able to break it down, and we see that about 1 ton is reduced through the investment of $70. And on an annual basis, we're able to reduce about 17 million tons of CO2 through the investments that we're doing in the energy space. So this is one factor, or one example, of how we address the reporting metrics. And then once we have those numbers, we go back to the social development goals that we've seen at the sustainable development goals that we've seen at the beginning, and we see which sectors or which goals that we can address with the investments that we've targeted. So for example, as we mentioned before, we said, sustainable use of products or reduction of CO2, we will be able to address these two topics. In the microfinance or in the agricultural space, obviously there's different goals that we can address, such as eradicating poverty, the equal pay for men and women, access to education, access to health, etc. In the agricultural space, we can look at topics such as life on land, life underwater. And so we can see how, with the investments that we're targeting, we're able to contribute to the achievement of different goals. In the impact investing space, you have different approaches. So for example, we at Responsibility take the thematic approach. You have other impact investors that look at specific goals and then set up their investment solutions to address these specific goals. And at this point, it's important for you as an investor to also set your priorities or your interest on saying, okay, for me, it's important to address as many goals as possible, or I want to address a specific goal with my investment. And then based on that, you can then make your selection of the investment solution. To wrap up, we do not necessarily need to be exclusive on one landscape, on one sector of this landscape. It's also possible to say that you want to allocate your assets across this landscape. But I think it's important for you to know what kind of an impact you generate with the money that you're investing, and also the fact that I want to give with you, and also in preparation for our third webinar, where we'll give you a backpack or a toolkit of questions that you will be able to ask your bank advisor. If you do not take a decision, the status quo is in the traditional sector. And with that, I would like to close and open the floor for questions. I think we have a few, Stacy.
Yes, let's see. I believe you covered this a little bit, Samuel, but we have a question here. How exactly do you measure impact?
So the impact measurement depends a bit on the sector. But so, for example, as I mentioned in the example with the energy sector, the fact that we work with private market placements, so we work directly with the companies that are not listed on stock markets, we require them to report to us the amount of tons of CO2 that they're able to reduce through the investment that we make with them. So we've developed a tool and the company that, for example, let's take a company that gives credits to people to invest in clean sources of energy. They need to record these products that the end client is purchasing, and based on that, we're then able to calculate how many tons of CO2 this client is not emitting, in comparison if he had, for example, bought a diesel pump versus the buying of a solar pump. And then with this tool, basically on a very regular basis, on a monthly or on a quarterly basis, we're able to show you how many tons of CO2 we're able to reduce.
Perfect. I have another question here. Can individuals invest in an impact investing fund?
That's a very good question. Thank you very much. Yes, there are a few impact investing funds available. It always depends a bit on the country that you live in. I can speak best for Switzerland, where we have an impact investing fund focusing on micro and SME financing. This is a retail fund, so anybody can invest with as little as 100 Swiss francs or $100 or 100 euros. So it is possible for people with small budgets to also do their part in impact investing.
Next question, are the portfolio management, asset management, investment management fees charged comparable to the traditional funds?
If you look at the traditional funds, I would say no. But I think also one of the core components, if you compare impact investing funds with traditional funds, we also take into consider an additional component, which is the metrics that we're reporting on. If you put your money in a traditional fund, you will not know what kind of an impact your investment has. You often hardly know what's even in this fund. With impact investing funds, you have a transparent reporting and you will see what kind of an impact your investment is generating. This obviously means that there's also more work behind the impact investing practices, and with that there's a higher cost. However, if you compare the return side of these funds, as we've seen in the poll question, the return in an impact investing on the mid to the long term is competitively comparable or even higher than in a traditional investment.
Next question. What are your finance sources? Are they mainly from institutional or retail investors?
So thank you very much for that question. Responsibility has not only institutional and retail investors, but we also have a third type of investors, which are the development finance institutions. At the moment, they're more or less spread third of each of the investor type. We do see, for example, in the microfinance space, we have a very large base of private investors, whereas then, for example, in the energy space, the base of investors are a bit more towards the institutional and also of the development finance institutions. But we do have quite a diversified base of investors, ranging from private small investors in our retail funds to large institutional investors as well.
Back to measuring impact, how do you make sure that the measured impact report and data collected from remote fields is valid and meaningful?
Thank you for the question. So we use benchmarks, and considering the fact that we have our investment officers who are on the field, we're able to collect this information and also cross-check it with peers and benchmark it. So basically, we get the information from the individual portfolio companies, and we will then review this information and check whether this makes sense compared to the peers, and also to, for example, reports that we get from the IFC or from other development institutions, and then be able to cross-check that and reassure that this is actually numbers that are in line with what we are expecting. When it comes to the meaningfulness, I think the main component is that we are looking to contribute to the achievement of the development goals. So I think if we're able to contribute, for example, granting access to about 40 million people through our microfinance investment companies, I think we're able to reach quite a broad number of people that would otherwise not have access to, for example, finance. Or if we're able to reduce 17 million tons of CO2 a year, that's quite a sizable amount of CO2 that we're able to invest with the amounts that we have available, and through that make this contribution.
Next question. Could you please give us a practical example, for instance, renewable energy, how a company or project was selected for your impact investing fund?
I will do my best. As I am on the relationship management side, this is not exactly my side of the business. We have our investment officers and our risk guys for that. But basically, we have, as mentioned, we have our investment officers on the ground. They will either search out or be contacted by a company that is looking for investments. We will then, after having done the due diligence on the financial component, so we will run, we'll look at their books. We will require the necessary, due diligence on the financial component. We will then also screen them through the ESG filters that we have. So we first want to make sure that this company doesn't cause any negative harm on the environmental, social, and governance perspective. We will then also look how they positively contribute to these same components. And finally, we will classify them. Based on that, they will be basically a low or a mid risk. And if they complete all the requirements, they will get the investment. Once the investment is done, we will then also go about to get the reporting data from them on a regular basis to be able to report back on the investment.
All right, a question. Do you do blended finance? Do you use development finance money to crowd in private money?
Yes, we do. We see that mainly in our energy investments, where the DFIs or the development finance institutions take up, or some of them take up a risk cushion, sort of a junior tranche in the investment solution that we offer to make also the investment more attractive to private investors.
All right, let's take one final question here. If I go to my bank and tell them to put all my investments into impact, can they do that?
The bank certainly can do that, yes. In the end, I think the investment decision is your decision. And I think you might also want to think whether you want to put all your eggs in one basket. But if you go to a bank, there's, especially here in Switzerland, there are retail solutions like the one that I introduced a little bit earlier. And you can put all your savings into that. I think you should, though, however, consider diversification of your investment portfolio. But in the end, this is your personal decision.
All right, let's wrap it up then. Thanks for everyone for joining. You can download the slides on the right and also our current impact report from 2019. And then please join us for part 3 of the series next week, where Samuel will give you some pointers about how to get more involved in sustainable and impact investing. All right, enjoy the rest of your day, everybody.
Thank you very much for joining. Have a good day. Bye-bye.